Hey, my name is Justin Porter, and this is the third video in a three-part series. The first video focused on competence, the second video focused on trustworthiness, and this third video is going to focus on, look, you're probably paying your financial advisor a good amount of money every year. So what services should you be expecting for the fees you pay? And I think this is really cutting the heart of the issue that pretty much every financial advisor says they do comprehensive planning, whether they do or not. That just sounds better than I'm going to sell you insurance, right? So that's one issue. The other is usually clients are paying on an assets under management basis. So you're paying for investment management, usually around 1% of assets under management, but you're getting planning for free. And that sounds great, but we all know there's no such thing as a free lunch, right? And so with that, you kind of got to figure out if you're getting the full planning experience or you're getting planning light. So this video is designed to help you determine that. First, most people come to their financial advisor for investments and to figure out if they have enough money to retire. Those are two very important things. I won't go into too much detail on investments. That can probably be covered by a separate video, but as far as planning, figuring out how much money you need to retire is an important question. But if your financial advisor really digs into the numbers, they can use that cash flow and net worth projection to answer a lot more for you. And I won't get too technical, but there's two types of planning software. There's goal-based, which basically say, hey, look, if this is your goal, this is how much you need to save for retirement. Or there's cash flow based, which is a little more modular, and it can dig into cash flows each year and how changes in your life impact your total financial plan. So I would suggest looking for a financial advisor that does cash flow based financial planning, particularly if you're a numbers person and want to dig into it. The other thing your financial advisor should be doing is giving you tax planning advice, right? They're not a replacement for your CPA at all, but they should be a really good complement to your CPA, because generally you're not seeing your CPA throughout the year, but you're seeing your financial advisor. So they should be trying to issue spot, as things come up in your financial life, they should say, hey, look, this is something you should be doing, or this is something you should be talking to your CPA about. They should be helping you with gain loss harvesting at the end of the year. They should be helping you manage your distributions from qualified accounts. And they should be trying to help you move money from taxable buckets to tax deferred buckets to tax-free buckets. And particularly with retirement accounts, I think that's really important because most professionals are dumping a lot into their 401k. But if it's a tax-deferred 401k rather than a Roth 401k, they're going to have trouble later in life. So I guess the main difference is your CPA is focused on this year and next year's taxes usually. Your financial advisor should be looking more long-term throughout your life. How do we keep your effective rate as low as possible throughout your lifetime? Estate planning. So your financial advisor should be working closely with your attorney, and they should be helping to educate you on not only what's in your estate plan and what's in the legal documents, but how are those funded? They should be a good go-between between the legal documents and the numbers, and then the family issues that go with that. Also, life insurance is a big part of estate planning. I choose not to sell life insurance. I'm more of a consultant. But whether your financial advisor sells it or doesn't, they should be educating you on what kind of life insurance you need. And that leads really well into risk management. So again, I don't sell any insurance, but I'm a consultant for my clients to help them know, okay, you have some gaps here. We should pull in your insurance agent to help solve these. Or that, so really risk management has three parts. It's risk shifting, buying insurance and letting someone else hold the risk. It's packaging up your risks and containing them in like an LLC or corporate form. And I call those bomb containment devices. And then all your really valuable assets we should put in a trust and they act like a bomb shelter. So if something blows up out here, your trust should be protected. So it's really a 3-part series. If you're a business owner, your financial advisor should be helping you plan for the exit from your company through succession planning. And if they're really good, they're going beyond that to help you run some numbers in the business and understand how that impacts your family. Executive comp, same thing. It's going a little bit deeper and figuring out when you should exercise some of those incentive comp options. And then finally, that's all analytical stuff. The last piece your financial advisor should really do is help you pass on wealth to the next generation. So coming up with a strategy to pass it on to your kids if that's what you want, that's analytical. But the other side is passing on the financial values that made you successful. So working with your kids to really create strong financial education in conjunction with you, but help them understand why this is so important. And then once they get a little older, help them understand what the plan is for the family so that they're incorporated, they're in the know, and they can start setting up good financial plans for themselves. So very long video. Thanks for sticking with me. Again, my name's Justin Porter, and this is the services you should be receiving from your financial advisor if they're offering comprehensive financial planning. Thank you.